Welcome to Good Practices for Good Boards, a review of the essential roles played by directors in governing nonprofit charitable organizations. This course was jointly developed by Board Strong, an organization dedicated to assisting nonprofits in achieving the highest standards of board leadership, governance, and oversight, and Board Source, the national leader in board education dedicated to advancing the public good by building exceptional nonprofit boards and inspiring board service. Good Practices for Good Boards covers 5 major topic areas. These are an overview of the nonprofit sector, the roles, responsibilities, and legal duties of nonprofit directors, attributes of a high-performing board, basic principles in financial oversight, and fundraising. You may decide to complete the entire course in one viewing or take a break between topics. The Board Strong website contains many resources if you are interested in learning more about the topics discussed in this course. At the end, there will be a short quiz in the material. When you complete the quiz with a passing score, your Board Strong profile will be marked with a star, so prospective boards will know you have completed this course and understand the rules and responsibilities supporting sound nonprofit governance. Before we begin, please be advised that the information provided in Good Practices for Good Boards is not intended as a substitute for legal advice. For details on current state and federal laws affecting charities, please consult an attorney with expertise in those areas. These attorneys are often known as exempt organization or nonprofit attorneys. Whether you are new to nonprofit boards or a seasoned professional, we hope you will find this course useful as an introduction or a refresher.
Topic 1, an overview of the nonprofit sector. Nonprofit organizations are a critical part of American and global society. They work toward reducing poverty and disease and bringing to an end homelessness. They strive to build safe places to learn and play, create inspiring art and music, and protect our natural resources. In basic terms, we can consider the economic life of America to be divided into 3 established and 1 or more emerging sectors. The first sector is the for-profit or private sector of businesses. The organizations in this sector sell goods or services and distribute their net profits to shareholders. The second sector is the government or public sector, which includes federal, state, and local government agencies that also provide goods or services in various ways and are generally funded by taxes and fees. The third sector is the nonprofit or charitable sector. Federal law identifies approximately 30 different types of nonprofits as eligible for exemption from federal income taxation. These types are identified by their internal revenue code numbers. The 501c3 charity is the best known nonprofit type. Examples of other types include advocacy organizations, which promote social welfare, such as by bringing about civic betterment and social improvement, trade organizations, and clubs. You will find many similarities between for-profit and nonprofit boards, and between boards of different types of nonprofits. But there are also many critical differences for boards of the 501c3 charity, which is the only type of organization addressed in this course. An emerging fourth sector includes hybrid organizations that operate for-profit but may pursue charity-like goals. As for-profits, these companies seek a double bottom line of profit and helping, but do so without enjoying either exemption from tax or deductibility for gifts. These hybrids include benefit corporations, B corporations, and L3C entities. Sometimes there is confusion about whether these organizations are nonprofits. They are not. 501c3 organizations must be organized and operated exclusively for charitable purposes, such as providing education, scientific research, prevention of cruelty to children, the elderly, or animals, or museums and performing arts. Importantly, the 501c3 organization is generally the only type of nonprofit that is eligible to accept tax-deductible gifts from donors. Because these organizations seek and accept gifts from their constituents and the public, they are the most highly scrutinized of all nonprofits. Stated differently, Even though all for-profit and nonprofit boards are held to certain standards, our laws and society have long recognized that charities hold a unique and special place in our society. The practices and principles in this course may be applicable to service on many kinds of boards. However, Board Strong's mission is to assist charitable organizations in achieving the highest standards of board leadership, governance, and oversight. Therefore, this course focuses only on board service in the 501c3 subcategory of the nonprofit sector. For convenience, we will refer to these organizations generically as nonprofits. Board Strong's work is primarily located in the state of New York, so we focus on its state laws. However, even if your state laws are different, the materials covered represent effective practices for all nonprofits. The United States nonprofit sector is huge, comprised of more than 1.5 million organizations spending well over $1 trillion annually. New York State's nonprofit sector is among the largest and among the most vibrant in the country, employing more than 1.25 million workers in almost 98,000 nonprofit organizations. 501c3 charitable organizations connected with New York recently reported revenue of $179 billion and held assets valued at over $288 billion. With nonprofits having such large responsibilities in our communities and state, the public expects nonprofit boards to operate ethically, legally, and to their fullest potential. One has only to look at scandals in nonprofit organizations to see what happens when boards don't do what they're supposed to do. Inattentive or underperforming boards face increased scrutiny from the New York State Attorney General's Charities Bureau and other regulators like the Internal Revenue Service. Laws set out basic fiduciary responsibilities for directors. Compliance with the laws is critical, but it is not enough. Performance is equally critical. Directors need to help their boards, individually and collectively, to perform better so that their organizations can better achieve their missions. As management guru Peter Drucker once said, management is doing things right. Leadership is doing the right things. It is important to mention at the beginning of this course that governance is separate and distinct from day-to-day management. Governance is collaboration between directors and management to achieve outcomes in an effective and efficient way. Nonprofit chief executives should carry out their duties based on policies set by the board. In addition, directors need to be willing and able to think strategically, challenge ideas, and probe for better solutions. Although they should bring independent thinking to decision-making, they must do so collegially with an eye toward inviting consensus. In the give and take in the boardroom, they must remember that governance is a team sport.
Topic 2, roles, responsibilities, and legal duties of the board and its individual directors. See, every organization is unique. No one-size-fits-all model of governance applies. There are, however, certain fundamental responsibilities common to all boards, which provide guidelines for board members. BoardSource has publications that explore these roles and responsibilities in detail. But we will offer a checklist here. The board of a nonprofit is responsible for 1, determining the organization's mission and purposes, including creating and periodically reviewing the statements articulating the nonprofit's goals, means, and constituents. How things get done is the role of management. Number 2, selecting the chief executive. Number 3, supporting and evaluating the chief executive. Number 4, ensuring effective planning and monitoring the implementation of the plan against goals. And number 5, monitoring the strength of programs and services and their consistency with the purposes and mission of the organization. Number 6, ensuring adequate resources through fundraising, fees for services, or other revenue streams. Number 7, protecting assets and providing financial oversight. This includes reviewing and approving the annual budget, the audited financial statements, and the IRS Form 990 annual return before it is filed with the IRS. This responsibility also includes ensuring proper financial controls and risk management practices. 8, building a competent board, including articulating expectations of directors, finding new candidates, orienting new directors, and periodically evaluating the performance of current directors, individually and of the board as a whole. Number 9, ensuring legal and ethical integrity. And 10, enhancing the organization's public standing. Here, it is important to explain a key difference between for-profit and non-profit boards. For-profit boards are accountable to their shareholders. In contrast, non-profit boards are accountable to the organization's members, if any, supporters, donors, and the public served by the organization. A nonprofit's mission is not to make money, but to improve the communities and the lives of the people they serve. These are the roles and responsibilities of the board as a team. Now we will discuss the legal expectations of a director as an individual. From a legal standpoint, each director's behavior is measured by 3 standards known as the duty of care, the duty of loyalty, and the duty of obedience. The duty of care refers to a director's responsibility to participate actively in making decisions on behalf of the organization, using the director's best independent judgment. A director should read board materials in advance of meetings and to attend meetings ready to discuss and vote on matters on the meeting agenda. In one well-publicized example of the breach of the duty of care, the directors let the chief executive run the organization without holding board meetings or obtaining board oversight. A director who is inattentive and does not participate in meetings can be removed from board service, or in serious cases, prohibited by the Attorney General from serving as a director in the future. In the case this refers to, the Attorney General appointed a new board, and the former CEO pled guilty to criminal charges. The duty of loyalty refers to a director's obligation to set aside personal and professional interests when participating in board discussions and votes. Stated differently, this duty requires each director to decide what is in the nonprofit's best interest at all times. An example of a breach of the duty of loyalty is the case where a director secretly purchased a parcel of land after learning at a hospital board meeting that the hospital planned to purchase that very land. The duty of obedience refers to a director's responsibility to ensure that the organization remains true to its purposes and mission through compliance with the terms of its certificate of incorporation and bylaws or trust agreement, as well as compliance with its contracts and all applicable federal, state, and local laws. An example of breach of the duty of obedience is the case where an organization spent donated funds not on its programs, but for the director's personal use. From a practical standpoint, each director's behavior is measured by standards such as regular attendance, participation, and donation of time and treasure, right? Commensurate with each director's personal capacity. Operating free of conflicts of interest is critical at all times. The duties of care, loyalty, and obedience are enforced at the state level by the New York Attorney General's Charities Bureau. The Attorney General is the person charged in New York state law with the ultimate authority to hold nonprofit boards accountable. The IRS can audit charities and hold their directors accountable, individually and collectively, for violations of federal tax law. At the federal level, other laws apply, such as penalties on transactions where a director or relative receives an excess benefit. An example of an excess benefit transaction is a case where a family sold a nonprofit's assets for less than fair market value to a for-profit company owned by relatives. Why join a nonprofit board? Well, there's a lot to think about when considering nonprofit board service. It is important to take a moment to ask yourself why. Why you want to serve as a director. A deep commitment to the organization's mission should be your primary driver. It is also important to consider the particular value that you could bring to the organization. Perhaps you have been an enthusiastic volunteer, donor, or fundraiser supporting the mission over the years. Or perhaps you have expertise in a particular area of concern to the organization, such as finances, real estate, or social networking. However, serving on a board goes far beyond doing one or two specific tasks. Board service requires you to take a big picture approach to the organization, seeing it in new ways that you might not have considered before. You will be called on to set the direction, think strategically, and to make decisions that may affect the organization for years to come. You will also be expected to learn about the issues the organization is designed to address. In the process, you are likely to develop new skills that will make your tenure as a director even more enjoyable and personally enriching. Board service isn't a hobby. It is a serious commitment of your time, talent, and resources.
Topic 3, attributes of a high-performing board. Good governance requires more than following a series of checklists designed to detect and prevent problems. It requires a board to balance its role as an oversight body with its role supporting the organization. On high-performing boards, every director must understand and should pursue some specific good governance practices. Here are some of the characteristics that excellent boards have in common. First, the role of the board is to govern, not to manage. Boards are responsible for organizational oversight and policy setting and delegate to the chief executive the responsibility for day-to-day management. Of course, it is not always easy or even possible to draw a clear line between governance and management, but the best approach is to see the governance and management roles as complementary to one another. The board sets the strategy for the organization, and the staff implements that strategy. Second, high-performing boards create an environment based on respect and candor that fosters a productive exchange of views. Directors are not afraid to question each other or to challenge management, because directors arrive at meetings well prepared, having reviewed materials sent to them in advance. They are able respectfully to listen to acknowledge and solicit different points of view and synthesize diverse views to further the dialogue and decision making. Third, directors understand and uphold the organization's structure. Individual directors are elected or appointed in a particular way set out in the bylaws. If an organization is a membership corporation that has legal members as opposed to donor members, then the members likely elect directors at the annual meeting of members. If the organization does not have legal members, then new directors are likely elected by the current directors. This is called a self-perpetuating board. Virtually all boards are elected by members or by existing directors, and some boards occasionally elect half of the board by each of the two methods. The board also appoints the officers, who may be a chairperson, a president, a treasurer, and a secretary. New York State law generally requires at least a chairperson who is not an employee of the organization and a secretary and treasurer. The bylaws may also provide for a vice president, assistant treasurer, or assistant secretary. Each of the officers will have duties that should be identified in the bylaws. Finally, the board hires the chief executive, often with the title executive director or CEO. The chief executive is responsible for achieving goals established by the board and manages the staff toward that end. The board chairperson manages the board with the support of the chief executive. The board relies on the board chairperson to communicate and coordinate with the chief executive between meetings. There are also some other critical attributes of top-performing boards that are important to discuss. One is that excellent directors are independent-minded and put the interests of the organization above all else when they are working on behalf of an organization. Independent directors do not allow their votes to be unduly influenced by loyalty to the chief executive or by seniority, position, or reputation of fellow directors. Instead, directors should rely on thorough deliberation to uncover all facets of an issue and distill their peers' perspective into an independent and educated opinion. Another point is that board meetings should be well planned and managed. Board-friendly materials should be distributed or securely posted well in advance of the meeting to allow for adequate review time. Agendas should be concise and alert directors to the decisions to be considered. The chairperson should facilitate the meeting, being attentive to giving directors appropriate time to discuss and vote on proposals, without permitting any particular director to dominate the discussion or silence other directors. Decisions should be recorded in draft minutes, which will be circulated for review and comment in advance of the call for amendments, corrections, and approval at the next board meeting. Directors who vote against a motion have the right to be named in the minutes as having voted against the action. Even though most boards act by majority vote, a chairperson may recommend postponing a vote or revising a motion in order to achieve consensus among directors. Finally, directors should be carefully selected, oriented, and trained. Directors should not rely on cronyism to fill the board. Instead, they should deliberately identify candidates with the motivation, values, experience, and skills to help the organization reach new levels of excellence. One topic that has not been covered yet is board size. No magic number of directors guarantees that a board will be productive. The best size for a board depends on the nonprofit's culture, whether it needs more people to fundraise, the experience and expertise of current board members, and the board work to be accomplished. The smaller the board, the easier it is to schedule meetings and achieve a quorum. A quorum is the minimum number of directors required under the charity's bylaws for a vote to be valid. New York law requires a board to have a minimum of 3 directors. Many charities consider operating with 12 to 15 directors to be optimal. Charities with complex operations or heavy fundraising programs may have a larger number of directors. Larger boards may have a greater breadth of experience and can share the workload among more members. The risk with a large board is that individual directors may not feel their input is necessary or desired. A productive board calls upon the talent, time, and treasure of each and every director. What are some good practices for boards in recruiting new directors? Before beginning the recruitment process, the board should prepare an updated director job description and a director letter of agreement. An up-to-date job description informs prospective directors of their roles and responsibilities, and the letter of agreement helps them understand exactly what is expected of each director. Providing this information to candidates at the start of the recruitment process will ensure that both the board and the prospective director are on the same page and will help avoid an early resignation of a director who didn't understand the commitments. As we have been discussing, nonprofits rely on active and engaged directors. Many boards have term limits, which is one important method for bringing new talent and energy to a board. It is also essential for boards to assume responsibility for evaluating their own performance and developing strategies for improvement. A board self-assessment provides the framework for setting priorities that will maintain the board's strengths and will address those areas in need of improvement. Assessment is one of the most effective ways to move the board of directors to the next level.
Basic principles in financial oversight. Directors of a charity are entrusted with guarding the organization's reputation and assets. They must make prudent decisions that are in the best interest of the organization and not subject it to excessive risk. People who have a special trust or responsibility to fulfill certain obligations are also known as fiduciaries. Boards can be held accountable if they do not perform their duties as fiduciaries, with the necessary care and attention to detail. A director's oversight role includes making sure that the board sets and maintains high standards of financial accountability. This means directors should understand the organization's sources of revenues, its categories of expenses, what financial controls are in place, what policies govern its financial management, and how and by whom its finances are monitored. A charity's 3 main types of income are earned income from rendering goods or services, unearned income or donated income, and investment income. The annual budget prepared by management and reviewed and approved by the board shows the expected expenses in the next year. Organizations should strive for balanced budgets, especially taking into account cash flow. Cash flow is the expected timing of funds in and out of accounts. Directors should carefully review the organization's budget and financial statements. There are special provisions in New York state law which require that most charities designate and maintain an audit committee of the board. This applies to every charity that is both registered with the New York Attorney General to solicit funds and required to file an independent certified public accountant's audit report with the New York Attorney General. The Act requires that the Audit Committee consists solely of independent directors, but permits Audit Committee functions to be performed by the board as a whole. Independent directors are those who do not have a financial interest in the organization. The Audit Committee should include 3 or more members, at least one of whom has a background in financial matters. The Audit Committee is required to hire and meet with independent auditors. The audit helps directors fulfill their fiduciary responsibilities by verifying that accounting standards are being followed and the organization is complying with its filing and reporting obligations to the IRS, the New York State Attorney General's Charities Bureau, and others required entities. It is good practice to have the auditor take the audit committee or board through the nonprofit's audited financial statements and notes, page by page, to make sure that directors understand the different categories of income and expenses and any warning signs of financial distress that the auditor may have identified. It is also good practice for the board to meet with the auditors without management present to get candid feedback on the competence of the organization's finance team. Finally, federal tax law encourages management of every charity to make available to directors before filing a complete copy of the organization's annual return on IRS Form 990. Every director should make a point of looking through the Form 990 to see how the organization presents itself to the IRS and to the public. The Form 990 is available free of charge to the public and will be posted on a variety of public websites, so accuracy is essential. There are 2 other requirements in New York state law, while not strictly financial in nature, promote good financial oversight. First, every New York state nonprofit is required to adopt a conflict of interest policy. The policy should apply to directors, officers, trustees, and key employees. It should include procedures for disclosing conflicts of interest to the audit committee or the full board, and should establish strict procedures to prevent individuals with conflicts from participating in board deliberations or decisions about matters where they have conflicts. Second, nonprofits with 20 or more employees and annual revenue of over $1 million must adopt a whistleblower policy to protect persons who report suspected improper conduct. Though not required for smaller organizations, a whistleblower policy is a good idea for entities of any size to protect directors, officers, employees, and volunteers who report suspected actions that are illegal or in violation of organization policy. The audit committee or full board must oversee implementation and compliance with the whistleblower policy.
Topic 5, fundraising. Fundraising, or helping an organization generate contributions, is one of many board responsibilities. Directors should take an active role in supporting the organization's fundraising efforts. A board's orientation should be very clear as to director expectations regarding fundraising. Lack of clarity about fundraising responsibilities is a frequent source of dissatisfaction on nonprofit boards. This is an area where there are no hard and fast rules that apply to every board. This makes it even more critical for each board and chief executive to discuss how responsibilities are to be shared. Board involvement is crucial to fundraising success. In most cases, by joining a nonprofit board, you make a personal commitment to contribute your time, talent, and financial support appropriate to your means or your capacity to raise funds from others. As a director, you should be prepared for the following. First, make a personal gift. Increasingly, Potential donors, such as foundations, routinely ask about board participation in providing financial support. The assumption is that you don't ask others for money until you have made your own contribution. To clarify director responsibility in this area, many boards adopt the policy that all directors are expected to make an annual financial contribution in an amount that is significant in terms of their own financial situation. Some organizations go even further and require specific give or get, or more recently, give and get targets. In addition, when a nonprofit conducts a capital campaign for special purposes such as a building or an endowment, each director is expected to make a capital campaign gift in addition to the annual gift. When directors demonstrate their personal commitment by giving to the organization, it becomes easier to encourage others to give as well. Second, ensure that the nonprofit has adopted policies to guide fundraising. Fundraising policies, plans, and goals should be tied closely to the mission. It is up to the board to make sure this happens. Boards should not get carried away with details, but should provide wise direction for management and staff, if any, and should clarify the role that directors will play in fundraising efforts. Directors need to understand that they all have a place in fundraising. Connections and introductions to donors, participation in fundraising events, and personal notes on solicitation and thank you letters all make a difference in terms of fundraising success. Fundraising plans and policies should at least address these points. How much of the annual budget must be raised from different sources, including earned income, donations, and investment income? What is the maximum amount or percentage of the budget that can be spent on fundraising costs? Should the organization apply for government grants or contracts? Are there fundraising strategies, such as direct mail or telephone calls, that the board does not want staff to pursue? What legal and ethical standards must be followed? New York State has fundraising pre-registration and reporting requirements and demands that solicitations contain clear explanations on how raised funds will be expended. Does the organization have a gift acceptance policy that will authorize the board to decline a gift that either does not support the mission or contradicts it? For example, a medical organization should have a policy stating whether it will accept gifts from tobacco, alcohol, or gun manufacturing firms. The board should select and encourage a fundraising savvy chief executive or, if resources permit, a development director. Development and advancement are code words for fundraising. Whatever the activity is called at a particular organization, the chief executive must expect to spend a significant amount of time raising money in cooperation with directors and development staff, if any. Also, directors should recruit other directors who are willing to raise funds. Each director brings to the board a unique network of contacts. Tapping into these networks broadens the organization's fundraising base and raises awareness of the work it does. Boards need to be balanced between workers and givers-getters, and will ideally be composed of directors who will all work, give, and solicit. If this is not the case, consider straightforwardly recruiting prospective directors who will be effective fundraisers, as at least some directors will need to lead the fundraising efforts in cooperation with management. In addition, the board should evaluate the organization's fundraising results. Staff can be too close to fundraising to evaluate results effectively. Approaches that work well at first may be continued far beyond their effectiveness. Further, practices change over time. For example, consider how much money is now raised through online campaigns as compared with event-based campaigns. Directors can also evaluate the cost-effectiveness of different strategies. Also, as donors themselves, directors may be in a good position to offer feedback on which strategies and messages best present the organization. Finally, boards must be aware of New York laws governing fundraising. These laws were enacted to protect charities and the public from fraud and theft. They require almost every nonprofit planning to solicit donors in New York to register with the Attorney General's Charities Bureau in advance of solicitation. The board should confirm that the required forms have been filed prior to solicitation, as failure to register has been prosecuted and resulted in significant penalties. In New York, if a nonprofit intends to raise funds through third parties, such as professional solicitors, professional fundraisers, fundraising counsel, or by means of commercial co-ventures, the board should confirm that the organization has complied with New York state laws. Descriptions of the rules regarding written agreements, copies of the contracts, raffles, and the like can be found at the Attorney General's website. In addition, directors might also want to review the Attorney General's report entitled Pennies for Charity. As the name Pennies for Charity suggests, this report alerts charities and the public to how extremely high the cost can be when charities hire outside fundraisers. Boards should confirm that appropriate due diligence has been conducted before contracting with any paid fundraiser or person who wants to advertise that sale of a product will benefit a nonprofit. If a nonprofit intends to solicit funds in multiple states, remember that the nonprofit may be required to pre-register and report annually in those states too. The organization's accountants or lawyers should be able to advise about these requirements. This concludes Good Practices for Good Boards. We hope that you have found this material helpful and that we have sparked your interest in learning more about the governance of charitable organizations. Please take a moment to complete the accompanying quiz and get your special star displayed on your BoardStrong profile. That way, any nonprofit considering you as a board candidate will know you understand your role and can get to work as a productive board member on day one.